Hi, welcome to the SEM Traders Desk. My name is Jeff Hyback, and I'm the Portfolio Manager for Strategic Equity Management. We're a SEC registered investment advisor based in Tucson, Arizona, and our focus is on active risk management for clients all across the country. Today, we wanted to give our fourth quarter economic update and take a look at where the economy stands right now, but also where it may be heading as we start 2013. What we're going to do is we're going to take a look at our leading economic indicators. And what we found is that if you zero in on certain economic indicators, it can give you an idea of where the economy is heading. And by doing that, it helps to frame the investment landscape, which then helps all of us make better decisions with our investments. Now, we're going to kind of go in order from the best economic indicators right now to the ones that are maybe struggling a little bit, and then we'll recap it at the end. Right now, the strongest economic indicator is stock prices. The stock market continues to improve. It's closing out a very nice 2012 after kind of being flat in 2011. And as you can see from this chart, it is heading back towards the highs that it achieved both in 2007 before it peaked, and again in 2000 in March just before it peaked right then. Now the reason this is important as an economic indicator is the stock market is basically the summation of everybody's perceived value of all the future earnings that each S&P 500 company will make. At the end of the day, you're simply buying the earnings of a company when you invest in a stock. So as the market improves, it's telling us that the participants, the people buying those stocks, believe that earnings are going to improve into the future. So when the stock market is above this 12-month moving average, which is the green line on the chart, the market is telling us the economy looks pretty strong right now. Another strong indicator right now is consumer sentiment. Now, most of you realize that consumer spending now represents 70 to 80% of our economy. And so we need a confident consumer to be spending money, because then that, of course, will equate into earnings into those S&P 500 companies or any small business out there. We just need consumers spending money, because that leads to hopefully higher wages, more jobs being created, so on and so forth. And as you can see, consumer sentiment is now back to the level it was at when the recession started, all the way back in 2007. So that's a very positive sign for our economy. The next big indicator that I think is pointing to strong growth is building permits. Now, building permits are nice to look at because of all the activity that goes into building a house. If you think about it, you not only have to have construction workers, but you also are buying materials for a home, and then when people finally move into that home, they have furniture to buy, window coverings, they want to landscape their backyard, so on and so forth. If it's a subdivision that's growing up in a new area, then you have businesses that are being created and to service that subdivision. So when we look at building permits, though, we don't necessarily look at the level they're at. What we want to look at is how much they've improved versus a year ago, because that's how much more activity we're going to have for our economy going forward. And as you can see, we're growing at nearly a 50% rate versus last year at this time. So that's 50% more economic activity we're seeing relating to that. And that can tend to pull economic growth along 1 or 2% higher based on this model. So just building permits alone, if that continues, gives us a nice wind behind our sails as the economy moves into 2013. However, we're not calling a bottom for housing. I mean, it could be bottoming. We don't know. We're not housing experts. We do know that we have a long way to go from the level of activity we were at way back in 2006 when housing tended to peak out. And, we're barely back to the depths of the 1990 recession at the rate we're at right now. So it could be a long way off before we see a final bottom in housing. But what's important, though, is this indicator is continuing to point towards improvement, which is good for the overall economy. Another indicator that is improving is the average work week. And the reason this is important, of course, is as businesses feel confident they'll tend to add hours before they go ahead and hire new people. And you could see how far it fell. It actually, when it fell during the recession, took out the lows from the previous recession. And it's made some gradual improvement, and it's still not back to where it was, but it is improving, and that's a very good sign. However, something that kind of concerned us when we saw the last jobs report is the rate of growth is slowing for this indicator. And that could be a problem for our economy, and it could be a sign that maybe we're going to run into problem in the labor force, because maybe hours will start to be cut back once again, which then will kind of to spiral down to consumer confidence, which can then hit stock prices. So it's something we kind of need to watch. Another indicator that I think is really important right now is payrolls. And the number of jobs being created are improving, which is nice. We've seen a number of months where we've seen higher payrolls. The problem is how far we have to recover. And we can see that at the current pace, which is around 150,000 new jobs per month on an annualized basis, it's going to take all the way till about May of 2015 before we get back to even. And that's something that is a big concern for us going forward, is that we're just not adding enough jobs to keep up with growth in the economy and to get stronger growth that we need. Another key indicator that is improving is service businesses. Now, manufacturing is important for our economy, but services have become a very key component to our economy over the last 30 or 40 years. And the indicator I like to zero in on is the Business Activity Index that shows where the service businesses tend to be heading, and they're continuing to show very steady growth. Conversely, though, on the manufacturing side, we're seeing a slowdown in my favorite economic indicator, which is the number of new orders for manufacturing. And you could see that during the last recovery, this was a sign of a very unstable economic environment. And you could see how far the new orders index fell. And it's once again kind of mirroring what we saw during the last recovery, which is it's leading the slowdown. Hopefully I'm wrong, and hopefully this indicator reverses and goes back higher, but for now it doesn't look good. And what looks even worse is the order backlog. Now, obviously, if we have a big backlog and this indicator was improving, it would show strong demand in the manufacturing sector. Unfortunately, the backlog continues to dwindle, and it's actually pointing to contraction in the manufacturing sector, which then that can filter through to, consumer confidence as if factory workers get laid off because there's not much of a backlog, or if wages start to be cut or whatever, we run into some problems. So overall, this is probably the weakest of our leading economic indicators, and unfortunately it's one of those that tended to lead all the other economic indicators during the last recession. When you look at it all together and you look at GDP growth, it really remains lackluster. What I drew there, that blue line, is the long-term average growth of about 3.2%. Now, it's interesting that this growth also is the rate that both the Federal Reserve and the Congressional Budget Office use as what they call sustainable growth. That's what they believe the economy is going to be capable of growing at. And if you see that blue line, since the recession ended in July 2009, we've only had 2 quarters that have exceeded 3% growth, and both of those quarters were due to some statistical adjustments that are made each year to kind of make up for all the estimates that they made throughout the year. So we've had a very lackluster recovery, and that continues. What's a bigger concern of mine is that dashed blue line that is showing that our long-term growth is slowing. And yet we have both the Federal Reserve and Congress and all of their budget estimates using a much higher growth rate. So if our growth rate does not keep up, then we run into problems as far as the budget goes. Tax revenues won't be as high. Um, we're, all the estimates they use for the surpluses, or in this case deficits, will be way off because our economy won't be growing as much as they estimate. But when we sum it all up, here's where we're at, just using our leading economic indicators. Above trend growth, we have several. We have building permits, and we have service business activity. Both of those are showing growth above 3%. And that's key because that's showing stronger than average growth. So those are two of them that we're going to continue to watch closely to see if maybe they can keep surprising us on the upside to point towards strong growth. Indicators that are showing growth of about 3% on an annual basis for our economy include hours worked, payrolls, and stock prices. So all of those stock prices and the jobs and the number of hours worked all point to about 3% growth for our economy. Now, the ones that are becoming a concern and showing below trend growth, so in other words below 2.5% or 3%, are the new orders for manufacturing, vendor performance, and capacity utilization, as well as consumer confidence. So even though consumer confidence got to a level that it was at during the last recession, what we've seen is a little bit of a slowdown in confidence, especially following the election, which we're going to talk about in just a minute. So overall, using our indicators and using our economic models, right now we're looking at an economy that's growing about 2.3% to 2.8% on an annual basis. To put that in perspective, the highest growth we've seen this year was in the third quarter, which the government estimates to be about 2.7%. So we're growing about what we were growing at in the third quarter. However, there's one key problem. We don't know what Congress is going to do. Of course, the fiscal cliff could be solved. Maybe they'll magically make it all disappear. But what we're seeing is that the issues that they're discussing as part of a compromise, or even the grand bargain that's been mentioned a few times since the summer of 2011, it's very negative as far as economic growth goes. So what I wanted to do was look at the fiscal cliff and see what it really means. Right now, as we say, we're growing about 3% for 2013. The leading economic indicators are saying our economic growth is continuing to improve. However, there's certain things inside of our government budgets and the bills that have already been passed that are actually going to pull down GDP growth by about 0.9%. So that's going to knock GDP growth to about 2.1%. And a lot of those are grouped into what they call other fiscal issues. That's a 0.75% drag on our economy in 2013. Those are things like the Obamacare Act that has a lot of regulations that go into place and new taxes on dividends and ways to pay for it, in addition to the actual taxes that people are going to have to pay if they don't provide their own health insurance or their employers are not providing for them. There's taxes involved in there. Some of the other fiscal issues also include the Financial Reform Act. There's things going into place that are going to cost businesses a lot of money. There's some taxes that are going to go into place to help pay for that. So already by itself, we're looking at GDP growth at 2.1%. That's before anything that they're even talking about. In addition to that, you have some other areas that are likely to be implemented because they're not even being discussed right now by the Republicans in the House or by President Obama. And those are going to knock off at least 1.45% to our economic growth, which brings our 3% growth all the way down to 0.65%. And so that's really something that concerns me. Some of those include the payroll tax holiday, which continued to be extended, and it was supposed to be a stimulus. It tended to be. They predicted it'll cut about 0.5% off of our economic growth. The emergency unemployment benefits has always been bundled in with the payroll tax holiday. Economists say that added about 0.25% to our growth. You look at the upper income portion of the Bush tax cuts, which it appears the White House is not going to compromise on. That's about 0.2%. It's not a big deal, but when you add it up to all those other things, it does start to become an issue. And then a portion of the spending cuts mathematically will have to be implemented. And so we said the sequestration is about a 1 to 1.5% growth. For sure, we're going to see at least 0.5% of that 1.5% implemented to get to that 1.45% hit that we're going to see the GDP growth. Now, all they're talking about is the compromise. Now, the compromise is trying to save about 1.5% of GDP growth. And what the compromise looks to be turning into is the middle income portion of the Bush tax cuts, which was going to be a 0.75% hit to GDP growth. The alternative minimum tax fix, which is something that always seems to we run into in December of each year because it's not indexed to inflation. The reason they don't index that to inflation and don't adjust it is because if it's looked to be expiring when they do their budget estimates, they can keep that revenue in there. Even though it's revenue our country never gets because Congress keeps extending it, it is included in the budget estimate. So it's a little accounting trick that they'd like to use in Congress, along with all these other temporary measures that they use. If they're temporary, they can budget that they're going to go away, which obviously helps the budget deficits look much better than they really are. And then we predict that maybe 0.5% of the sequestration amount is going to go away. So overall, really the fiscal cliff fight is about a 1.5% hit. Unfortunately, we're already going to see that 0.9 and that 1.45% hit to GDP. If we don't get any compromise, if they do what they're calling go over the cliff, and they just continue to fight about it, we're looking at a negative GDP growth rate in 2013. Now, most people don't believe that's going to happen, but you never know. Most people didn't believe that the debt ceiling fight in 2011 would go on as long as it is. So the problem we have when it comes to the economy and the stock market is we believe the market is not only pricing in the likely compromise of the 1.5% savings to GDP growth, but they don't seem to be factoring in economic growth that's going to be somewhere between 1.5% to 2% without it. Even if they get a grand compromise. The market, as we saw, is predicting about 3% economic growth. That's a problem. When the market wakes up, sometime maybe it's before the year ends, maybe it's going to be soon after the new year starts, that's when you run into the issues. At Strategic Equity Management, we're here to help. And we've covered just briefly some of the economic issues we see. There's a lot of big picture problems that our economy is facing, from the level of debt to the problems that we see continuing in Europe, to the entitlements. We've written a lot of different articles on our website. It's stratequity.com. What you do is you click on the button. If you're an individual investor, you would click on Investor. If you're an investment professional, we can provide you a little bit more details on some of our programs and our models, and you would click on the professional link. Now, you don't have to be a client of ours. You don't have to be an investment professional of ours. It's simply for compliance purposes. We have to verify that not everybody can see what's on our website. There's no obligation if you register for our website. We're not going to send you anything more than an email to confirm that you are a real live person and not some person in China trying to spam our website. After you get that verification email, feel free to log in. On the right-hand side of the page, there's something called Trading Desk Updates. Every morning I'm writing a blog about what I'm seeing in the market, what our models are seeing, what I think is important as far as the next few weeks or even the next few months. You can get all of that on our website. I hope this information was beneficial to you. I definitely enjoy looking at the economy, and I plan on doing this as long as possible. We will be back sometime next year with another update. Until then, I hope everybody has a Merry Christmas and an enjoyable New Year.